Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. Once again, I have my great friend, and he's guzzling down some holiday coffee today. Al, how you doing today?
After each sip, I get a little bit better.
How many cups is that today?
Actually, this is the first one. So
not too bad. Not too bad.
Bouncing off the walls by 3 o'clock.
There you go. It's always great to be back helping our Retire Young family make better investing decisions. Al, we have a jam-packed show once again. It's earnings season, and there's a lot of things happening in these financial markets. We're seeing a lot of volatility. That should be, that's been kind of the theme for the past several months. And we have a lot of listeners that just want to gain more knowledge and more financial literacy in what's happening in these financial markets. So before we dive into some of the topics we're going to cover today, the 401ks, IRAs, how the successful are creating income, Al, I want you to recap with what's happening. Earnings season's here. We're seeing a lot of volatility, big moves up, seeing big moves down as well. What's going on, and how can the average investor participate in these markets?
Yeah, you can actually call some of these moves insane. It's almost like things on steroids, and we saw that last week. There are, when you think about it, Josh, the movement, the upward movement and value in the market right now is based pretty much on the movement of 5 stocks, the 5 biggies. You've got Facebook, Apple, Amazon, Microsoft, and Google.
Better known as the FANG stocks.
And then Netflix typically is thrown in there too. Yep. But if you had 49% of the NASDAQ 100 is made up of those stocks, and then 23% of the S&P 500 value comes from those 5 stocks. This is earnings season. By the end of next week, all those companies will have reported. So, eyes are on that. And with the values that those companies have achieved, one of 2 things will happen. If they miss earnings, they're going to get punished. If they beat earnings, then the opposite will happen. So earnings season is an interesting time for us, but it's a time that we need to be careful about not being protected. This is maybe a great time to do one of 2 things. Well, actually 2 things. It's a great time both for taking advantage of short-term kind of tactical trades, and in addition to long-term strategic investments. And both are really important. If you're looking for short-term value in the markets, then you're going to use different assets than you will for the long-term. And we'll talk about that a little bit more in that second segment. But what we've also seen is some rotation. A lot of people put together a portfolio that is just a one-time portfolio, really, that they think is diversified, comprising many different sectors, and then they just hold on to it for decades. Well, we've seen rotation from the technology sector, which has really built this movement in the market, into for a couple of days it was the COVID-related companies, the companies that would do well after the COVID was in check and control, like the airlines and the cruise lines. That lasted very short. And then there was a rotation into the energies and the financials. So the point I'm getting at is that if you just put money into one thing that covers everything, you're always going to be in something that underperforms. And if you can identify where the big money is, and that's institutional money, where they're putting their money, then you have an opportunity to participate in those sectors and industries that are outperforming and get out of the ones that are going to be underperformers.
That's the key, is opportunity. We have this different rotation. We have earnings, and you mentioned that, if they have bad earnings, there may be some punishment for them, in the market. But, the markets move by the big institutions, the big money, like you're kind of alluding to there. It's supply and demand. So just dissect a little bit how these financial markets work. There's fundamentals, but there's still technicals, and there's actual price action that is dictating these markets.
Right. And if you can participate in that price action, wouldn't that be a great opportunity for you to benefit from these markets, regardless of which direction they're going?
That doesn't lie. That's actual price action. That's
correct.
Not an opinion even.
No. The fact. The only thing that's really factual and that's going to be here on a reliable and a repeatable basis is that relationship between supply and demand. In the financial markets, that's a relationship between buying and selling. And the goal, of course, is to get in at the best price, whether you are entering a position or getting out at the best price. Easy to say, and it makes sense, but how do you do that? Well, the institutions are they're really creating a situation where price changes. They have such clout, such financial clout, that if they put a position together where they're going long or buying, they have enough clout to move the price up. It's that basic concept of supply and demand. Mm-hmm. When they are selling, the opposite happens. So the key then is to identify what they're doing and why are they able to be successful on such a consistent basis. One of the reasons is that they do have an advantage that we don't have, and that is that they know things about these companies and about the markets that we either don't ever really know or we know too late to participate in the full benefit of it. In other words, they're buying research. They put millions and millions of dollars a year into research. So if we don't have the ability to do that, wouldn't it be better then just to follow what these guys are doing? And that's the important thing. We always want to make sure that we keep things as simple as possible. That's getting in at the best price, getting out at the best price, and the best way to do that on a consistent basis.
You're right, and you kind of mentioned that last week. You were talking about Kobe Bryant, how he followed and mimicked everything that Michael Jordan did.
Correct.
And think of supply and demand or how the markets work as an auction. You have an auctioneer, and that'd be the whole bid ask. There's an auctioneer selling, let's just say, that cup of coffee. And that cup of coffee, they're going to say, we're going to sell it for $2. You're going to have many, many people buying that or bidding for that coffee. So price is going to continue to go up until there's one buyer and one seller. And then on the flip side, when there's more sellers than buyers, price is going to go down. So if no one's going to buy that cup of coffee at $10, that auctioneer's got to lower that cup of coffee price. So that's how the financial markets work. And Al, you teach a lot of investing classes where you talk about how Wall Street is trading and investing, how the institutions are continuing to do over and over what the institutions are doing, or at least at low risk, high reward, high probability entry points into these markets. And you mentioned it's all about where to get in your positions, but also where to get out and take your profit. Al, I hope you got another cup of coffee there because we got a lot more to cover. On the next segment here, I want to get into kind of how the successful are trading for income. We have a lot of listeners that want to understand, how are the successful creating more than one source of cash flow? And so we're going to talk about some of the different asset classes and how they do that. So this is Josh and Al. We will be right back.